So thanks everybody. Thanks for coming over and joining the webinar where Rahul Tabhane from the FCO will be walking us through of the opportunities on UK export finance. And we will also have Arun Aggarwal, one of the venture partners of Pontaq, will be giving his real life experiences of working with UK export finance and the benefits thereof, followed by Q&A. In the audience today, we have a few portfolio companies of Pontaq, and we also have the team of Pontaq and also some of the venture partners join in from UK, India, and the US as well. So thanks, Rahul. Thanks for making the time. If you could, the stage is yours.
Sure. Thank you, Prem, and thank you everyone for joining in. I think I have already shared the presentation copy with you all. So I'm dialing in from a landline, so I really do not have. I have it in front of me, so I hope that you are referring to the same presentation because I'll be reading through the same.
Correct. So Rahul, we have the deck shared to all the participants. So if you can let us know which slide we need to go, and we will navigate.
Okay, so basically I'm on the second slide right now, which is how can we help you trade with the UK. So just to give you a background, UK Export Finance, we are a UK government department and we are an export credit agency of United Kingdom. This year we are celebrating our 100th anniversary. And since last 100 years, we have provided financing support worth 30 billion pounds for promotion of British goods and services across the globe. And last year alone, our financing support was 6.8 billion pounds across 75 plus countries, supporting almost 270 plus British exporter companies. So what we do is basically we play a central role in British government's ambition to make sure that no viable UK export fails for lack of finance or insurance. And that we try to do with the help of providing either direct lending from UK government or UK Treasury, or second is providing UK sovereign guarantee basis which the companies can benefit with superior credit profile of UK government, and with this guarantee they can go in the financial market and borrow long-term low-cost financing to support the trade activity. We can support British exports of any size across all the sectors. It can be capital goods, it can be equipment, it can be services, intangible such as intellectual property, R&D, technology. So there's a myth surrounding UKEF support that it is available only for export of goods, which is not the case. If you look at the statistics, half of British exports are made up of export of services. And that's the reason why, as UK Export Finance, we are also open to provide our support for export of services from UK. Now what we follow is called as OECD guidelines or OECD arrangement. Just to give you a background, OECD is a block of some 30 plus developed countries who have signed amongst themselves an OECD charter, basis which they have laid down some rules for promotion of exports from their own individual countries. And it is basically a level playing field which has been created for each and individual country among that OECD bloc, so that every country who's trying to promote exports from their own cannot provide certain concessional terms against other country to promote goods or exports from their own country. So basically all the OECD ECAs, including UK Export Finance, follow this OECD arrangement. Under which the biggest benefit which a UK exporter or an overseas buyer can get is long tenor financing. I'll come to that in subsequent slide. As I mentioned, last year our support was 6.8 billion pound across the globe. Previous to that, in 2017-18, we provided support worth 2.5 billion to support almost 181 British companies exporting to 75 countries. I am going to the next slide, which is slide number 3. Now, UKEF support broadly falls into two categories. As I mentioned, we can provide either UK government sovereign guarantee, or we can provide direct funding from UK government as well. Now, across this, we can also provide this support on both ends of the trade, which is happening between the UK company and their overseas buyers. So we have certain products for the UK exporters, and we have certain products for overseas buyers. So the first half of the slide talks about the product and services that we offer to the overseas companies, which are typically a buyer's credit facility, a supplier's credit facility, or a direct lending from UK government. Now, all these products are basically long-term financing products, wherein minimum repayment period which is offered by us is of 2 years, and the maximum repayment period which we can go up to is 10 years if we are looking at providing financing support on the basis of corporate balance sheet or corporate guarantee-backed transactions. For project finance transactions, we require a minimum transaction size of 50 million pounds. We can provide repayment terms of up to 14 years. If it's a transaction in renewable space, green energy space, then we can provide repayment terms of up to 18 years as well. So if I can give you an example, suppose if there is a project in renewable sector wherein there are British exports which are going. So if an overseas buyer of those British exports is looking for a financing support from UK Export Finance, then we can offer him the repayment terms of obviously 18 years. But since the project will also have a construction period of 1 or 2 years, you can look at a door-to-door financing of 20 years, which will have first 2 years as a project construction period or a loan disbursement period, and next 18 years would be the repayment period. So such long tenor financing are generally not available with commercial banks because they are not ready to take such long-term risk on any project or any corporate. So that is one of the biggest advantage which UKEF or ECA financing provides for overseas buyers who are looking at ECA support. Also, project financing, as I mentioned, is not something that all the ECAs do. UKEF is one of the very few ECAs who look at project financing transaction. And there we require a minimum transaction size of 50 million pounds. Anything over and above 50 million can be considered on a project finance basis. And obviously, it will depend on a case-to-case basis evaluation whether we are okay with that particular project or we are ready to take a market risk on that particular project. Now, direct lending is also one of the products that we offer. But this is something that we would offer in markets wherein we see there is a limited appetite of private banks or financial institutions to provide financing. So generally, we look at markets wherein UK exports are very substantial, but still the overseas buyers struggle to get financing from private financial institutions to fund that particular UK purchase. That is when UKEF comes into picture. And one of the recent examples of this direct lending facility is when we provided $310 million worth of direct lending facility to the government of Ghana for their oil and gas exploration project. Then after that,
the representative from Relatives for Medical Scheme for Locally Engaged Staff is present on the 10th floor in the Corporate Services section till 4 p.m. Thank you.
Sorry for that announcement. I'm actually in office. So the next product is that product and services that we offer for UK exporters. Now, from UK exporters' perspective, we do not have any threshold of minimum transaction size, whereas we have the threshold of a minimum of 5 million pounds when we evaluate our support for overseas buyers. So for UK exporting companies, all the short-term products such as working capital support, bond insurance support, export insurance policy support, and there are some couple of other products that we have on offer, basically just to help UK exporting companies to bid, win, and get paid for the contracts or the supplies that they are exporting globally. We have also recently introduced something which is called as untied working capital support, wherein even if the UK exporter does not have an export contract in place when they are talking to us, we can still support them on an overall business level basis to effectively manage their working capital levels or cash management across the group. Now, this is basically to make sure that the UK exporters are able to deliver on their contracts overseas, and also to make sure that they expand in the process and create enough capacity or create more capacity to export out of UK. Now, all these products for UK exporters are run in conjunction or in subordination with the bank. So we do risk participation with a relationship bank or a bank the exporter deals with on a regular basis. We actually, that is how it works. It's actually with the basis of the bank who's working and leading in the transaction. And there are actually some 20 banks who we have nominated on our automatic trade digital platform, and the details of those banks are also available on our website. So all the short-term products which are on offer from UKEF, if any of these banks feel that they will benefit their UK clients who are exporting across the globe, then these banks can simply go to our digital portal and avail these products with a de facto UKEF guarantee available to them. Now I am on fourth slide, which is basically the UKEF offer to global buyers. As I mentioned previously, for global buyers, we offer long-term financing, either in the form of direct loans from UK government or 100% unconditional sovereign guarantee of UK government, which allows these overseas buyers to spread the cost of this purchase over a period of time. Now, what we offer are basically repayment terms of 2 to 10 years. As I mentioned, for project finance, we can go to 14 years. For renewables, we can go up to 18 years. Now, our support is restricted to 85% of the total export contract value, provided there is a minimum of 20% UK content. Now, what this means is basically if you have an export contract, export contract between a UK company and overseas buyers worth $10 million, what we require is basically a minimum of $2 million should be delivered from UK under this contract, and balance 8 million can be delivered from any other third country except the borrower's country or the buyer's country. If that is the case, then we can support up to 8.5 million of that 10 million export contract value. So basically, we have kept this UK content or home country content criteria very flexible, keeping in mind that UK often does not have enough manufacturing capacity across the sectors. And even though it is available, we do not find a lot of UK suppliers or equipment companies supplying across the globe. And it is basically the UK services which are very much in demand. But the quantum or the volume of the services or the amount of the services are so low that sometimes we find that there is not enough content when we look at our support for overseas buyers. And that's the reason why the content criteria is kept so low at 20%, which is one of the lowest across OECD ECAs. And 85% of the contract value is again a restriction which has been put by OECD. So any OECD ECA who is looking for an export finance support will not be able to provide more than 85% of the export contract value. Balance 15% is supposed to be the buyer's equity into that export contract value or the project. Now, as an OECD ECA, we are quite flexible to meet buyers' requirement. We provide them with innovative products such as capital market refinancing or Islamic financing. In fact, we have been awarded as the best ECA by two agencies last year, GTR and TXF, if I'm not wrong. And we have been consistently ranked as one of the most innovative ECAs or the ECA across the globe who is supporting the exporters of their host country. One of the other innovative aspects which I think only UKEF has across other ECAs is we can also provide our financing in 60 plus global and local currencies. In the context of India, we can also do that in Indian rupees. So this is basically to take care of the currency hedging cost which comes into picture when an overseas buyer borrows in foreign currency. Hedging cost on a long-term basis also adds another 15 to 20% cost on an overall financing, which gets negated if the buyer or the borrower wants to borrow long-term in Indian rupees. And for that purpose, we are ready to provide UK EF guarantee in Indian rupees as well. And obviously, we try to maximize our support through reinsurance arrangement with the global ECAs, wherein we feel that apart from UK, there is a third country content coming from countries like France or Germany or Korea or Japan, wherein we already have reinsurance structures and agreements in place with ECAs of these countries to make sure that we deliver maximum benefit to an overseas buyer. For doing all this, we charge an insurance premium, which is again benchmarked as per the rates set by OECD guidelines. And again, these rates are determined on a case-to-case basis. The two most important factors which drive the insurance premium is one is the credit profile of the overseas buyer, and second is the tenor for which our support is required. So obviously, if overseas company is looking for a 10-year support, vis-a-vis a company looking for a 5-year support, will have to pay a higher premium because it's a higher risk. And this premium is again paid as upfront cost as a percentage of an overall loan amount. This can also be financed by a financial institution. So there is no need for an overseas buyer to pay the premium from their own pocket. If they wish to choose, they can get it financed along with the loan amount, and then they can get it amortized over a period of a loan along with the repayment structure. Now I am on slide 5. So this is a schematic representation of how UK funding works. So as I mentioned, when we are providing a sovereign guarantee, there has to be a bank in the picture who will lend on the basis of this guarantee. So in the representation, you will see that there is a foreign buyer, there is a UK exporter, there is a bank, and obviously there is a UK export finance. So essentially, what is happening is UK export finance is providing UK government guarantee to a bank. Bank is placing the entire risk on UKEF and lending to the UK exporter or the foreign buyer in this case. And obviously, the foreign buyer, once they draw down from a bank over a period of time, in the repayment period, they return the money to the bank. And obviously, there is a loan agreement in picture between the foreign buyer and the bank. And with UKEF and between UKEF and the bank, there is a guarantee agreement that we share with them, stating that if the foreign buyer fails to pay back the loan to the bank, then it's UKEF who pays to the bank. The UK exporter is obviously having an export contract with a foreign company, and against the deliveries or supplies that they do to the foreign buyer, the bank is paying them the contract amount. Now I'm on slide 6, which is actually a summary of whatever I have said till now. And it also gives you an idea of our risk appetite on India, which is almost 4 billion pounds at the moment. So any UK export across sectors, across goods and services to India worth 4 billion pounds can be supported at the moment. And as I mentioned, UK financing offer buyers an alternative source of financing. It also offers financing in Indian rupees. It provides them long tenors, which are generally not possible in plain vanilla bank financing. And obviously, when they are borrowing on the basis of UKEF sovereign guarantee, the cost of that borrowing is getting reduced substantially. Then after that, I have a couple of case studies which of various projects across the sectors and across countries that we have delivered. And the objective of this is to just showcase that UK does have a supply chain available across the sectors, because most often we hear this noise from overseas companies that there is very little that they can buy from UK, or they have no clarity what to buy from UK. But the point of putting this case studies here is basically to showcase that across sectors, UK can deliver on various projects, and basis which only UKEF has provided this financing support in various countries. So if you go to slide 8, there is a bridge project in Sri Lanka we have supported quite recently. This is a company called as Cleveland Bridge, who has constructed 250 bridges across Sri Lanka, worth 49 million pounds, and this was financed by UKEF. Then on slide 9, you will see there is a community market, hospital and airport project that we have recently delivered in Ghana. Then on slide 10, we have cleaning wastewater project in Bahrain. On slide 11, again a healthcare and power project in Angola. Then a real estate project in Dubai. Middle East has been one of the biggest market for UK export finance, with a lot of UK exporters, services as well as construction companies quite active in that market. So we have provided our support for development of an entire island with a loan worth $317 million. Then with respect to India, my territory, we have provided our support to Reliance Jamnagar with 100% unconditional guarantee in 2013 with a USD 300 million loan. In this particular facility, Reliance was importing goods and services from UK from some 25 different SME and MME companies, and they consolidated all these contracts together to create a line of credit for them, supported by UK Export Finance. Slide 14, this was an example I mentioned previously about the direct lending, which was done by UK government for this offshore project in Ghana. It's a 400 million project wherein we pitched in with UK government money of 310 million, and balance 90 was done with the help of a financing bank on the back of UKEF sovereign guarantee. And the contract or the project was delivered by GE Oil and Gas. Then we have also supported Red London buses to Mexico City, as mentioned on slide 15. We provided a financing package of 44 million pounds here for sale of 90 red double-decker buses by Alexander Dennis. Then ELAL's new Dreamliners in Israel. Aviation is again a big portfolio within UK Export Finance. Traditionally, we have supported a lot of aircraft transactions because of the Rolls-Royce engines which get manufactured in UK and fitted on Airbus aircrafts traditionally. The recent transaction, or the latest one that we have done in Qatar, as mentioned on slide 17, is sale of Typhoon and Hawk aircrafts. This was the largest single transaction which was done by UKEF, £5 billion worth of support to the government of Qatar. Then bringing energy security to Iraq on slide 18. We have supported almost more than $1 billion worth of projects with building of 2 new power stations, restoring and building electricity substation. And for this, we have also conducted a supplier fair within UK to identify the UK supply chain. So now I am on slide 20, which talks about UK supplier fairs. Now, most often when we go to when we speak to the overseas buyers or the EPC contractors who are looking at UKEF support to deliver on their projects, as I mentioned, most often the one question which comes regularly is that how do we identify UK supply chain, and how do we know that is there a market available within UK who can deliver on this equipment or on a particular service. So that is when we conduct this UKEF backed or organized supplier fairs, just to do a matchmaking between an overseas buyer and a UK exporter to make sure that their demands are met, and this can obviously be supported by UKEF financing. So on slide 21, you have an information about the supplier fairs which have been conducted by us in the past. So be it for a petrochemical plant in Egypt, or a power project in Iraq, or in Tanzania, or a refinery in Oman, or with GE Healthcare in Africa and India. We have conducted this supplier fairs across UK, bringing all the UK exporting companies in one room, doing this matchmaking events and generating a business pipeline worth millions of dollars for the UK companies. And that was my last slide on UK export finance. I am happy to take any questions if there are.
Thanks very much, Rahul. Much appreciated. One question, the questions seem to be coming right now, but before we go into the question, could I kindly request Arun Aggarwal, a former MD of Swift and who has also had the experience of setting up a company, a bank in the UK, of SMEs, funding, and we work with UK Export Finance, to give his views of how easy and what are the various avenues for various companies.
Thank you, Prem. Yes, okay, now let me give just a few minutes. If I don't hold up questions, that's always the most useful part. But just give a few minutes. Thanks very much for that very good, clear presentation around the UKEF offerings. So my own experience is a long history of both corporate treasury management for large companies, as well as Prem says, the setting up of a UK bank specializing in trade. So quite a bit of trade finance experience. I really wanted to just make a few points before we move to Q&A. There is clearly, as we've heard, a very deep set of propositions that UK Export Finance can offer. And I would certainly encourage everybody to try and avail of those, from the financing products to the matchmaking, sort of marketplace products and services that UKEF has. The issue that I think two or three things I would just mention. One is that, as already stated, for a lot of the offerings, you need to go through a bank. So you need to work with either your established bank or a new bank to make use of the UKEF products and services. What we've certainly found, I've certainly found, is that it's quite variable in terms of the support that you get from the banks, and certainly when you're talking about large, long-term project finance, large scale contracts, it's of course easier. I think probably, and I think that's true with UKEF as well. A lot of the focus is on the big flagship projects and long-term projects. Smaller day-to-day trade financing requirements, your normal day-to-day trade financing requirements, which are more like for working capital funding, which is maybe for a period of months rather than many years. Getting the banks to pay attention, give you the support that you need can be difficult, and sometimes all of the products and services that are available are somewhat confusing. So making the application and then putting together the business proposition for the banks and for UKEF is something that needs a bit of care and attention. A lot of people do fall at the very first hurdles because they just don't get the key points across and don't get the response they need from either the banks or even ultimately UKEF. So it needs a bit of care and attention. I would point to two or three things that are really important. One is to really understand your financing requirements and your financing strategy. One of the things that, give a couple of examples, people look at, okay, I need financing from exporting my product to when I get paid. Actually, one needs to look very carefully at what I call the full trade life cycle analysis, the true end-to-end. From the moment at which you're starting to incur any cost whatsoever, you're taking an order, you're starting to do some work and therefore incur costs specifically, all the way through to finally cash is in the bank. What might feel like a 6-month credit period all of a sudden turns into a 12 months or an 18 months credit life cycle or a cash life cycle that you're required to be funded. So what really is your funding requirement? The worst thing in the world is, and many young companies who are exporting or importing and taking orders, big orders for the first time, find that the biggest danger is great order, really exciting. Have they got the liquidity to see it all the way through from the start to the end? And so really understanding what I call the trade life cycle analysis, the end-to-end cycle, and then all the way through that cycle, all of your funding requirements, liquidity requirements, and your risk issues throughout the whole process is a very fundamental piece of analysis that needs to be done. Which a good trained, bank relationship manager or a bank product specialist can do, or an independent consultant can do, but it needs that thought to be put in and then presented back, to the company's own management to understand what financing is really needed, what's the true cost, true end-to-end cost that they should be building into the trades they're doing. And then using all of that to present a very clear and powerful picture to the bank that you're looking for support with, and to UK Export Finance if you're going down that route. So that sort of that type of analysis, and then within that, understanding the risks at every stage of the process. At what stage of the process are you incurring costs, which is potentially irrecoverable? At what point does control of the goods pass? And when the control of the goods pass, have you got the financial and risk management instruments in place in order to make sure that you are covered? And then how you also use all of this to your advantage, because one of the things that we're already hearing, of course, with UK Export Finance, if you can, as part of the package, offer your buyers UK government borrowing at a preferential rate to what they could achieve domestically, then clearly that's a differentiation for you in terms of winning orders. Equally, you can use it in other ways. In terms of, and I'll talk less now about long-term project finance and big contracts, but again, your general orders that you're trying to win. What currency are you agreeing the contract in? Easiest thing in the world is for you to say, well, I want it in my domestic currency, my home currency. If you are willing to take the contract in the currency of the buyer, and then you do the currency hedging at the other end, that can again be actually net beneficial, either in terms of winning the contract or even in terms of improving the margins. Equally, you might want to offer extended credit period, because actually you raising the finance, let's say a UK exporter raising the finance here with or without UK export finance support, can be a better deal ultimately for the buyer to give him an extended credit period, and then help that process to win the contract. So there's a number of things that the analysis needs to understand and then use either to raise finance, raise risk management tools and techniques, use the right tools and techniques, and there are a whole range, and really link the end-to-end as well, because one of the things that we are seeing is that all too often a invoice, a sale is often based upon importing of certain goods. Well, if you're doing import finance at one end and you're doing export finance at the other end, or maybe not export finance, maybe you're importing and you're selling in terms of domestic sales, and you have a receivables invoice that you can discount. If you link the end-to-end together, it often allows you to release some credit capacity and allows you to take greater financing from the banks. And again, these are the different strategies that need to be thought through. But if they are thought through, it is both in terms of the financing cost, but also risk management, which with exporting, there is clearly a greater risk. I mean, the distance, the currency, the legal differences between the jurisdictions, there are greater risks. How are those risks being covered by the different instruments that you use, or through the contracts that you have? And of course, all of this can be used to differentiate yourselves, help you to win contracts, and help you to make contracts not more profitable. And if you don't, simple things like FX risk over a longish term contract, let's even say not terribly long, 1 year, 18 months end-to-end life cycle, FX risk can seriously eat away at the profit margins. So all of these things, there's upside, and there's also downside to be managed, and this is thought through. Okay, so I just wanted to give you that. I think that that hopefully is a few pointers in terms of as you enter the use of different markets, or maybe it's the first time the scale of the export is rising, you need to raise finance because it's the largest order you've ever had. These things sometimes can be tricky to get through the banks, and a good understanding of your own business and a good presentation of the strategy and the requirements, the business proposition is very critical for you and the bank. So that's a few pointers, and also happy to take questions afterwards.
Thanks, Arun. That is comprehensive. Rahul, do you want to add a few more points in addition to what Arun has just mentioned, or are we okay to go for a Q&A?
No, I'll just add that, sometimes, obviously, all our products wherein we are just coming up with UK EF guarantee, we will definitely require a bank to work alongside, because the bank is going to be the one who is going to fund either the exporter or the overseas buyer. So that is definitely the requirement. Also, we also find, and as Arun has rightly mentioned, there are a lot of companies who are not aware about the application process, what kind of documentation we would require, and also the process in general. But we are ready to do the hand holding, and I'm not sure whether you have gone through our website. We have the entire process laid down for each and every individual product that we offer. We also have the contact details of our 24 regional export finance managers who are based across UK, handling various territories, and they are responsible for a UK company who is based out of their territory and looking at UKEF support. Their contact details are mentioned on the website, so they can reach out to these export finance managers directly with any query, and this EFMs, as we call them, can work alongside the UK company to deliver UKEF product or structure a financing solution for them.
Cool. Thanks, Rahul. So if I can jump off to questions, the first question from Christine from Pontaq. So Christine's question is, what's the typical timeline for securing export finance?
Sorry, can you repeat that question?
What is the typical timeline for securing a UK export finance?
Now, it's a very subjective question. So if I am talking to the overseas buyer who's planning to buy from UK and looking for a long-term support, so the typical timeline can go anywhere between 3 to 4 months, practically. Because what you have to understand that when we are coming into a picture with our support, we are taking the entire risk on the overseas buyer, and we are transferring that risk from the financing bank to us. So in that case, we have to do a credit analysis or a due diligence on that overseas buyer in terms of their financial credit worthiness, their history, their past track record, any other thing which can be instrumental or material in finalizing our decision. Most often, we also find that the documentation or the paperwork required for achieving this financing is not put in place properly by these overseas buyers, and that is also one of the reasons for delay, wherein we do not get the entire information on day one for us to process the application. So the practical timeline, if you ask me, would be anywhere between 3 to 4 months. If we are looking at a project finance transaction, then it may increase further because project finance is again a very enhanced risk for us. So we'll have to do additional due diligences in terms of market risk, legal risk, local regulatory requirement, and other factors. So in terms of project finance, it can go up to 6 to 7 months as well. If you're talking about our financing support for a UK company with short-term products, this can be a faster channel. As I mentioned, we have already onboarded some 20 different banks on UKEF digital platform, wherein there is a pre-checklist which has been provided to these banks, and if any of their customers who are looking for UKEF support fulfill all the tick boxes in that particular checklist, then they can actually complete this transaction even within a matter of hours. So for UK companies, it can be as fast as even 1 day, but depending on where they stand on the documentation, where if there are any other issues which needs to be sorted, then it can also take up to maybe 15 to 20 days as well. But on overseas buyer side, definitely, I would say 3 months is a minimum timeline that we can look at.
Good. Thanks, Rahul. The next question is from Pilgrim. Pilgrim is the CEO of Device Pilot. For context, they are a software as a service business. The question from Pilgrim is twofold, which is the examples that you have provided are more about financing physical assets. but are there real examples of financing service delivery or more so digital set of products or software? And the second part of the question is it more about purely guaranteeing payment to the UK vendor rather than the financing per se? So your thoughts on that, Ram?
So the case studies which I have provided are basically the financing that we have done in the past. Unfortunately, whatever financings we have done had a mix of goods as well as services. So all these projects which I had mentioned, or the financing which I had mentioned, had their fair amount of service portion as well, in addition to goods. But I don't think there was any project wherein there was a digital service provided or a software export which has been supported by us. I may be wrong. I don't have an idea about it. I mean, these are the case studies which are available on our website. But that doesn't mean that each and every transaction has been converted into a case study. So I have to check whether we have provided our support for any software or a software related service export. What was the second part of the question?
The second part of the question is it mainly about guaranteeing payment to the UK vendor rather than financing per se? But before we quickly go on to this, Rahul, I mean, if you could kindly come back to us, whether you're able to provide software support for software companies as well, that'd be useful, and also the length of that. Such exercises in terms of export finance, that'd be useful because a sizable portion of our portfolio is software only.
Yeah, I do understand that, and I don't think there is any restriction on us in providing support for software companies or export of software related services. But as I mentioned, I need to check whether we have done that in the past. That is my only question, and I'll have to check with my HQ in London if we have done that, or what are the criteria surrounding to that support.
Okay. Maybe just to chip in there. So, as you say, Rahul, certainly as my experience is, there's no restriction in terms of whether it's goods or services. Your export credit guarantees can be applied to both. But equally, I would say that a lot of the other issues and requirements that I talked about earlier on apply just as much to any export. Once you're exporting, the same sorts of issues apply. What are you doing in terms of foreign exchange risk, your currencies of invoicing, what timelines are you getting paid by, therefore what level of financing do you need if you're developing some specific software, when do you start to incur the cost, and therefore what level of financing do you need through that life cycle. So a lot of the same issues apply, and then you do have issues around control, which is maybe moving a little bit off financing. But if you are exporting software in terms of things like IP protection and those other contractual issues, of course, come into play. But it's a slightly tangential. But if you're looking for export finance guarantees and then using that through your house bank or another bank, pretty much the same process does apply, but you are working through the bank in that case. These are typically not the big direct, project financing, overseas buyer financing type situations, and the bank has to get comfortable with, your proposition, etc. So same principles apply.
Thanks, Arun. Thank you very much. So moving on to the second part of the question, which I will repeat, is this all about purely guaranteeing payment to the UK vendor than financing per se? Rahul?
Yeah, so basically, it is to make sure that if there is any hindrance for that UK exporter to back that particular export contract, and if financing offer is going to tilt that offer in his favor, then it is all about that. So it's all about financing that particular purchase if the overseas buyer feels that he does not have a capacity to pay for it to the UK exporting company. Also, the other benefit which UK exporter gets out of this is because UKEF is involved in the entire structure. And if you have seen that schematic representation of how the funds flow and what are the kind of agreements that we enter into. So whenever the UK exporter is providing that particular service or equipment to the overseas buyer, and when they submit the invoice to the bank, they get paid through the bank. So obviously there is more guarantee or a confirmation of a payment which is going to come to the UK exporter in this particular structure, rather than a structure wherein a UK exporter is directly dealing with an overseas buyer. And we have often seen cases wherein payments get delayed over a period of time, and there is a lot of hue and cry and a lot of push or a follow-up which needs to be done by a UK exporter to get the payment, even for the services or the product that they have supplied on time. So one of the advantages I would say of this particular structure is that your payment is somewhat secured because it is coming through a bank with a structure which is backed by UKEF.
Cool. Thanks, Rahul. We have 4 more minutes to go. Possibly have one more question to take. Any questions around the table? If there are any questions, please kindly speak up. Cool. I take it as a no. And thank you very much, Rahul, and thanks, Arun, and thanks everyone for joining this webinar. It was very useful. What we will do right now is we will close the call, introduce all of you over an email, and also send the recording of the overall webinar so that it is of benefit to everybody. And if there are any further questions anybody might have, please do reach out to Rahul directly. Thanks everyone once again.